Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, March 29, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had a pretty quiet day out here, very light volume, as you can tell down here on the bottom where the volume is. 52 million shares, just short of 52 million shares. And that's typical after a couple of big up days like we had from Monday and Tuesday. We had a reversal on Monday. We had a nice big up day on Tuesday and a little bit of an update today in the Spider. But all in all, not that much. And it was basically a lackluster day for the most part. However, what my expectation is going forward, and here's what's important, whether or not we trade up to the 20-period moving average tomorrow, which comes in at about 236.44, call it 236.50 for argument's sake, that is possible. That's another dollar higher from where we are. But my expectation is that we're going to see a pullback. Whether or not we trade up there first or we just have a pullback, I think tomorrow my expectation is we're going to have a pullback. Generally speaking, after an important bottom, we had a reversal, we had an important bottom made. We went up for 3 days in a row, including that day, and you'll generally see the market pull back a little bit. You had a lot of people that hopped on the rally, and they're the people that the market is going to fool tomorrow, in my opinion. And it's not a guarantee we're going to have a pullback tomorrow. It's just my expectation. It's not really as much from a technical aspect as it is from a gut feeling based on where we are. We're trading up into the 20-period moving average. We're close. We had 3 up days in a row. We had a reversal on Monday. We're in this red bar high, okay? This red candle, the high of 237.61, I said red bar high. We're not into the high, but the point is that we're not going to just walk through that candle. That's not going to happen. The market's going to do some backing and filling. And I believe tomorrow is as good a day as any for some of that backing and filling to occur. I'm not looking for the market to make new lows or anything. That's not what I'm saying. I'm just saying, a 10, 15, maybe even 20-point pullback in the S&P is not out of the question. So that would do the trick in opening the trap door a little bit and scaring some of the people or tricking some of the people that were the last to the party on the upside. And that's just generally what the market does. All I'm really looking for, if you look at it, is a retracement. So if I bring up the 60-minute chart and you look from low to high, where am I looking? I'm looking to come into about the moving averages. Whether or not we do it all tomorrow or it takes a couple of days, that's really irrelevant. I think that we retrace somewhere in between 50 and maybe even 618 of this move. That would bring us to 234.5, 234. In that neighborhood is what I'm looking for in terms of a pullback. If you're a willing buyer for the longer term, and longer term, let's say for the next 6 to 8 weeks, then it may present a buying opportunity. You don't go all in. It's somewhere to dip in if you haven't been able to dip in thus far. I'm not expecting to break the lows, and if the lows were to break, I don't think we go past 230, 228 on the downside. So either way, it's a relatively reasonable area to get involved in the market if you're not involved on the long side thus far. And so with that, we can move on, and we'll find out tomorrow. Let's go back to the daily chart. We'll find out tomorrow if I'm right or not, obviously. Looking at the IWM had a nice update today, more than the Spider. That's bullish. The IWM was up about 1/3% today. The Spider was up only 0.1%. And we're into the moving averages on the IWM. So same routine here. Maybe there's a little bit more of a push higher, but we should stall out around these moving averages. Whether or not we push higher by another 50 or 75 cents is really irrelevant. We should turn back down and just put in somewhat of a pullback pattern in the IWM, the Spider, across the board. That's my expectation. So really the same routine that we just discussed. moving along. We go to the transports. And transports stalled out a little bit today. We were down 20 points in the transports, not a big deal. And the transports will likely come down along with the broader market if that's the case. And you can see the divergence a little bit, right? The IWM is indicating bullish because it was up leading the spider, right? It was leading on the upside. So if you just looked at the IWM and you looked at the spider, you would say, well, the IWM is signaling higher prices coming in the spider, and that may be the case. However, you look at the transports, and the transports were down today, so we had a mixed market out here. And even though I like them both as leading indicators, you can't make anything out of leading indicators that diverge in and of themselves. So we'll just leave it alone, and we'll move it along. But there's nothing to say that the IWM can't push up into the 20-period moving average, which is the red trend line. However, we are into this red candle high from yesterday, and we weren't able to surpass that today. So my expectation is that we won't either tomorrow, and that maybe supports the case for a pullback. We haven't taken a look at the NQ in a week or so why don't we do that? And what you'll see here in the NQ is very, very bullish, butting up against the highs. The high was 54.41. We're at 54.36 and change right now. So whether or not we break out to new highs in the NQ, which is the NASDAQ 100, remains to be seen. It looks like we will. That's very possible. But the NQ has been the stronger index the entire time. So even if we're coming down from new highs in the NASDAQ, okay, and I'm not expecting a bloodbath out here or anything, I'm just saying a little pullback, the NQ, maybe it comes back down to the 20-period moving average or something. That's not all that big of a deal. So the NQ in the bigger picture remains the bullish index of them all, and it is signaling higher prices coming. I have no change in my expectation across the markets that we will see higher prices into, whether it's ending in May or June, but into the next couple of months, we will see higher prices. My expectation is for higher highs in all the markets, and I'm still sticking with that forecast. We always discuss that this corrective phase that we should be completing right about now was that just a correction. It wasn't going to be a bear market. It was just going to be a pullback in the larger scheme of things where we're in a bull market, and that is continuing. We have no reason to believe the bull market's over. When you look back at the chart in a couple of months, this will just be a blip for a month on the chart, and my expectation is that we'll look back from higher prices than we've seen yet. Very bullish chart on the NQ. Going over to gold. Gold's still treading water in this upper range. My expectation for gold is we will see a pullback. I'm not exactly sure how deep of a pullback. I don't know whether or not we can get all the way down to the moving averages. If we did, down to that 1230 and change area, that would present a buying opportunity. It would represent about a 50% retracement from low to high. And I don't know that we get there, but my expectation is that we do need to work off some of this overbought condition, and another, let's say, $10 lower in gold over the next day or so looks to me in the cards in my book. That's not all that big of a deal any way you slice it or dice it. I still think there's another leg higher coming in gold, and all we have to do is work off some of the overbought condition, which will set the stage for another run higher. But from here, and I've been telling you this for a few days now, I don't think gold has the mustard in the jar to really get through these highs and the 200-period moving average and such. We really need to reset the tape and build some energy, go sideways, eat some time off the clock, a little bit of a pullback, and then we can reset the clock for another move higher. So that is what we need to do. That's my expectation, and we'll see what happens over the next couple of days. This looks like a green candle, but it is down $4 today. It's down from yesterday's pit session close, so I didn't want anybody to be deceived by that. Looking over at silver, we've stalled out at the 200-period moving average. That's not expected. Generally speaking, any market, when reaching after a pretty large move to get there, when reaching the 200 period moving average on the daily chart, will provide resistance at least for 2 or 3 days at minimum. Again, along with this story in gold, my expectation is we will pull back to work off some of this overbought condition. We did not get above yesterday's high. Yesterday marked the 10th day from the low, and that, generally speaking, should provide a pullback scenario, and that is what I'm expecting in gold and silver. And also, by the way, similar to the spider, here's this red candle high, right? We're not going to just walk through that, a double top, a big, heavy volume down day. Markets generally don't just rally up to those and bust right through them. What they do is they come up, they test it a little bit, they pull back, they build some energy, they consolidate for a while, and then they're able to get through them. Because of the volume, unless they go up on tremendous volume, it's unlikely they're going to be able to get through that without a decent consolidation phase. And that's what my expectation is. So we'll just take it one day at a time in gold and silver, and we'll let the market dictate what the next larger scenario is going to be. Moving over to crude oil. Crude had a nice big update today. We're heading towards the 20-period moving average. It is downsloping. It will provide a level of resistance for the market if we can get there. Whether or not we get there could happen overnight. If we get there, that's fine. I don't expect us to get through there. And what's interesting is you'll notice on the bottom of the screen, there's a trend line. And one of the members brought this to my attention today. He's pretty astute in his own right. And the reason I missed this was because I didn't have the chart pulled in close enough. And now if you look, you can see this trend line. This is a really bona fide trend line that I wish I saw last week. And remember when we discussed this doji candle that got put in after the low, and I said you can trade this against that candle low, against the daily close below that low, and I didn't see that trend line at the time. Had I saw that trend line, I might have pounded the table a little bit and obviously brought this to your attention, and I probably would have taken a trade myself. I did not. However, as you can see, it held very nicely, and generally 3 hits of a trend line like this will hold at least for several days, and that is what we're seeing here. And it may hold for longer. This may mark the low for a while. We may not see the 45 I'm looking for. That's obviously possible. However, if you look at the trend line and you look where this low is here, which comes in at 44.22, you can see that if we did break this trend line, the first area we would go to would be this pivot low that comes in at 45.46. And then if we broke that, then we go down to the 44.22. So 45 was a ballpark, and I still think that is possible if we came back down. But this trend line's holding, and anytime you see a trend line like this, basically it doesn't matter whether it's a stock, a commodity, any chart. When you see a trend line and you have the third hit of a trend line like this, way more often than not, I would say at least 75% of the time, if not more, they will hold at least for several days. So that is something that you can put in your notebook and remember, because whether or not it's a stock or anything else, and it goes from the upside and the downside, if you have third hit of a trend line, that's generally a good sign that you can take that trade and you have a very defined stop loss. Any close below that trend line and you move out of the trade. So it's too late now because we're too far away from it. But had we been able to see this trend line, and had we been able to take a trade on that trend line or based on that trend line, that would have been a very, very tight stop loss and obviously would have worked out wonderfully. But I didn't see it, and that's the way the market works. Some people see them and some people don't, and that's just a function of the market. But great job, Jordan S., for pointing that out. Very nice work. All right, let's head over to the bond market. And I want to unsqueeze this chart. There we go. Okay. Now, I thought we would come down a little more in the bond market. You can see here we made this top. Yesterday was the down day we were expecting. And today was a little bit of an up day. So we'll see what happens. You can tell we seem to be putting in a sideways consolidation pattern. It's not done yet. It needs more time in the oven. I don't think we're just going to bust up through here. Maybe we go a little higher, maybe we don't. But my expectation is that we come down to at least the 50-period moving average in order to also reset this market for another run higher. So I don't think we're done on the downside of the bond market. But if I'm right and we do get a pullback in the stock market, it wouldn't be uncommon to see the bond market rally along with that downturn in the stock market. So tomorrow we may see another up move in the bond market. And if you take a look at the hourly chart, you can see here that this is above the moving averages now, was consolidating pretty much all day around the 50-period moving average. So it is setting up for another little leg higher, but I'm not sure how much higher we get in the bond market. But with tomorrow, if we do see any downward pressure in the stock market, we may see an upward move in bonds as well. I'm really looking for the major move in bonds to take place really in the second half of the year. Call it from the summer beyond. Between now and then, don't be surprised to see some more back and forth just like we've seen of late. I mean, this whole year has just been back and forth. I don't think that's going to end until we get into the summer period where we should see a change in character for the stock market, and we should also see a change in character for the bond market. If we do see significant downward pressure in the stock market in the second half of the year, then you will see money rush into the bond market and you'll see yields get pushed lower on the expectation that the Fed isn't going to be able to raise rates as they have indicated they will 2 or 3 more times this year. That's not going to happen if we see significant downward pressure in the stock market. The stock market always dictates what the Fed is able to and not able to do. Despite what they tell us about the economic data and all that junk, it's not really how they make their decision. They make their decisions based on whether or not the stock market is in a bullish or bearish phase. Nothing more, nothing less. You've never seen the Fed raise interest rates, at least not over the last 10 years. You haven't seen them raise interest rates in the face of a declining stock market. I don't think we're about to see that now. And taking a look at the US dollar, we saw another little uptick in the dollar today, and this is normal market behavior. We continue to work off some of the oversold condition. We may get one more up day. We may even trade up to the moving averages. At that point is when I would expect the dollar to be rejected and go back down. We may not even get to the moving averages. We may get rejected at this red candle high here at just over 100. 100's a nice big round number. Maybe we pierce through it a little bit up to 100.50. But my expectation is that we'll just turn back down. So we'll end up seeing one of these patterns here from a short-term basis. Down, up, down. And what is that? It's an ABC. And we see that over and over and over again. And I think that's exactly what's developing right now on the dollar. And with that, I'm going to wrap it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.